The average new car payment now exceeds $730 a month, typically for a term of 68 months. By the time that contract is finished, you have committed nearly $50,000 to an asset that loses value every single day you drive it. But there is a way to step out of that cycle. You can sever your financial relationship with auto lenders for good and never owe another dime on a vehicle. This requires a strict set of rules. We are going to buy used vehicles in cash, aggressively screen out shady sellers, and execute a system that redirects those old loan payments into an automated wealth-building engine. Cutting out this one recurring monthly bill provides immediate cash flow relief. It creates a predictable surplus in your budget, allowing you to absorb unexpected expenses without relying on new debt. To make this work, we have to look at how new cars are priced. The moment you drive off the dealer lot, a new vehicle drops 20 to 30% in value. By year 3, the average vehicle has lost half of its original price tag. Look at the exact math on this chart. If you buy a new SUV for $35,000, its value shrinks down to roughly $19,250 after 36 months. That highlighted loss zone represents a $15,750 hit in depreciation alone, costing you over $400 a month before you even factor in insurance or maintenance. If we expand our view to the 3 to 5 year window, the math flips in your favor. Someone else has already absorbed that initial depreciation hit, leaving you with a modern vehicle at a 40 to 60% discount, often with the factory powertrain warranty remaining. There is exactly one exception to this rule. When automakers have excess inventory or a redesign is imminent, you will sometimes see heavy manufacturer incentives. If you can find $12,000 in rebates that drop a new $35,000 car down to $23,000, buying new gets you 0 miles and a full warranty for less than the cost of a used model. Most of the time, however, you're buying used, and your ideal target is a single-owner vehicle with a completely documented service history. Meticulous owners who keep their maintenance records are the gold standard of the private market. Conversely, immediately walk away from sellers who refuse to provide the VIN before meeting. The same goes for vehicles carrying out-of-state titles with zero explanation, or sellers who won't allow an independent inspection. Screening sellers this aggressively prevents you from inheriting a neglected machine. You sidestep the primary cause of predatory auto loans, overpaying for a vehicle that is already falling apart. Even with a pristine service history, a third-party pre-purchase inspection, or PPI, is mandatory. Budget $150 to $200 for this step, and consider it money well spent even if the results force you to walk away from the deal. A visual walk-around in a parking lot is not enough. You must have the vehicle securely elevated on a lift in a professional bay, inspected by an independent mechanic that you chose, not one recommended by the seller. A basic inspection can easily miss catastrophic flaws. In one instance, a standard surface-level PPI missed failing transmission mounts, deteriorating brake lines, and severe intake manifold issues. A second, much deeper look on a lift uncovered over $5,200 in required repairs, saving the buyer from a devastating mistake. Once you buy the car, assume the baseline maintenance is at 0. Change the oil immediately so you can see exactly what comes out of the engine. On older vehicles, proactively replace timing belts and address any deferred maintenance the seller disclosed, like worn brake pads, before they fail. When it is time to actually pay, you change the rules of engagement. You negotiate strictly on the out-the-door, or OTD price. This is the exact final cash amount it takes to walk away with the keys. Focusing solely on the OTD number prevents the dealer from playing games. They can no longer artificially lower the sticker price, only to add documentation charges, window etching fees, or expensive add-ons once you reach the finance office. By demanding a rigorous lift inspection and negotiating a strict OTD price, you eliminate the unknown variables. You turn a high-risk purchase into a sound strategy for preserving your capital. Now that you own a reliable car with 0 debt, you execute the most critical step, the phantom payment. You are going to continue making your monthly car payment, but you are going to pay it to yourself. If you would have paid $500 a month to a lender, that exact amount is now automatically redirected directly into a dedicated, interest-bearing car fund. This cash needs to earn interest while it sits. You can park it in a high-yield savings account currently earning 4% or more, or use a money market account, which offers similar rates but gives you check writing privileges for immediate access when you need to handle a repair. This requires consistency. Mentally categorize this money as already spent. It is strictly for vehicle repairs and future replacement capital. You never touch it for vacations or home improvements. Once your car fund hits your target replacement price, for example, $20,000, you execute the dual fund system. Your $500 monthly phantom payment splits in half. $250 stays in the auto fund to cover maintenance, while the remaining $250 flows into a long-term index fund. By routing half of that phantom payment into actual investments, you are compounding wealth over decades, all using money that most consumers hand over to a bank in interest. This system flips the math of ownership. The vehicle is no longer a liability draining your income. It becomes a tool that helps you fund your long-term retirement accounts. Step 1. Avoid massive depreciation by buying in the 3 to 5 year window. Step 2. Verify the condition on a lift. Step 3. Negotiate a strict out-the-door cash price. Step 4. You become your own bank. Most consumers spend their lives continuously financing machines that are losing value. When you break that cycle and execute this cash strategy, you keep that same capital working for your own net worth instead of the bank's. Do not wait for your current car to fail before starting. Pick an interest-bearing account today, determine what your future phantom payment will be, and set up your very first automated transfer. When you stop paying interest on a depreciating tool, you remove one of the largest obstacles to building wealth. By keeping your income in your own accounts, you give yourself the flexibility to fund your future on your own terms.